everyone, and welcome back. Okay, let's just dive right into this explainer because we have a lot to cover today. We are going to unpack a massive, entirely hidden mechanism that is operating right beneath our feet. We're taking a really structured, deep dive into the shadow economy to figure out exactly why the financial system still seems so stable on the surface, despite all the unbelievable pressure building up underneath. Get ready because the data we're looking at today is completely going to reframe the financial reality we're all living in.
I mean, it's the question on everyone's mind, right? Why hasn't the whole thing just collapsed yet? Look, if you've been walking around feeling a deep, almost constant sense of economic anxiety, you are absolutely not alone. There is this overwhelming mainstream narrative constantly telling us that, hey, total stability has been achieved, everything is fine. But when you actually go out and look at your grocery bills, or you try to pay your rent, or you glance at the housing market, things feel incredibly fragile. Well, today we're going to use the hard data to validate that anxiety and question what is really holding this entire system together.
Because right now, there is just a stark, undeniable disconnect in our economy. On one side, you have the official government narrative telling us that inflation is hovering around a totally manageable 3 to 4.1%. But on the other side, you have the everyday reality for the bottom 90% of earners. We're talking about a staggering $2 trillion shadow banking system operating completely out of sight, effectively holding the broader economy hostage. It's literally a tale of two entirely different financial realities.
Which brings us to Section 1, the Great Economic Disconnect, the S&P 500 versus your wallet. The investment class, the folks tied to the soaring S&P 500, and the average worker are basically operating on different planets right now. Just look at the housing market. Back in 1985, the median home price to income ratio was about 3.5. Buying a house back then was a big deal, kind of like buying a luxury car. But fast forward to the projections for 2026, that ratio hits 5.0. It's financially equivalent to an average worker trying to go out and buy a private jet. Today, just reaching the median home price of $422,000 practically demands a six-figure salary. And sure, official data might tell you that the average savings for Americans under 35 is around $20,500. But come on, that math is so heavily skewed by the ultra-rich. The everyday reality for most people is much, much lower.
Let's move on to Section 2, the true cost of living and the 9% secret.
Okay, so when you actually peel back the layers of those official statistics, a completely different picture emerges. In 2023, the official Consumer Price Index reported inflation at a neat 4.1%. But the Ludwig Institute calculates something they call the True Living Cost Index. They notice that high-income earners spend a ton of money on discretionary items, stuff you don't actually need to survive, and those prices are surprisingly stable. But when you strip away those optional purchases and look exclusively at unavoidable essentials, things like food, housing, and transport, the inflation rate jumps to a devastating 9.4%. That was literally the highest annual jump in essential costs we've seen since 2001.
And that horrifying jump leads us directly to this chilling number, 95%. According to the data, 1 in 3 low-income households right now is forced to spend about 95% of their total income on basic, unavoidable needs. When essential inflation hits 9.4%, it absolutely crushes these families. I mean, it leaves zero room to breathe, let alone save up or invest for the future. So if purchasing power is just collapsing for so many average people, why on earth hasn't the housing market crashed like it normally should when demand falls?
Well, that takes us to Section 3, the golden handcuff effect and the housing trap. The key phrase you need to know here is golden handcuffs. Usually, when inflation rises, interest rates go up, and that cools down housing prices because buyer demand drops off. But there is a massive catch right now. The supply is trapped. By the second quarter of 2025, an estimated 52.5% of all mortgages were locked in at rates below 4%, mostly secured during the pandemic. Meanwhile, new loans are sitting way up above 6%. Homeowners literally have zero financial incentive to sell their house and trade up to a new loan that's going to be twice as expensive. It's exactly as Dr. Selma had pointed out. She noted that this lack of supply creates a tight market and a severe affordability challenge, completely locking people out of homeownership. In fact, this lock-in effect kept an estimated 1.72 million homes completely off the market between 2022 and 2024. The supply of available houses is being kept historically low, which artificially props up all these sky-high prices and leaves first-time buyers out in the cold. All right, but the housing freeze is honestly just the surface. Let's peel back the darkest layer of the entire economy in Section 4. shadow banks, and zombies. So, remember the 2008 crash? Regulations like Dodd-Frank were supposed to come in and make traditional banking much safer, but instead of fixing the problem, a huge chunk of lending just moved out of the sunlight. We are talking about a $2.1 trillion private credit sector operating totally outside traditional banking rules. These shadow banks assess their risk using a really controversial method called Mark II model. Instead of valuing their loans based on actual transparent market prices, they just use their own opaque financial models. It's essentially financial guesswork happening behind closed doors. And because it lacks traditional oversight, nobody truly knows the actual value of the assets these entities are holding. They could be masking massive amounts of toxic loans right out of the public eye.
And who exactly are they funding with all this shadow money? Well, get this. Deutsche Bank estimates that as of 2020, an unbelievable 18% of publicly traded U.S. companies were officially considered zombie companies. A zombie company is a business that barely generates enough revenue to cover the bare minimum interest payments on its debt. They're legally alive, sure, but financially, they are completely dead, surviving day to day only by borrowing even more money. Let's actually step through exactly how these undead companies manage to stay afloat on paper. They use a vicious accounting trick known as PIK, or payment in kind. It goes like this. Step 1, the company realizes it can't pay its interest in cash. Step 2, instead of defaulting and going bankrupt, those missed payments are just rolled directly into the outstanding debt balance. Step 3, the total debt mountain just grows larger and larger. It is a massive, incredibly risky game of pretend and extend. And it's a huge deal because back in 2020, these zombie companies accounted for 2.2 million jobs, all just slowly creeping toward total insolvency.
Which logically leads us to Section 5, the K-shaped wealth divide and the invisible default. While major corporations are busy managing their invisible defaults, a brutal K-shaped divide is absolutely gutting the middle class. Just look at the shift in U.S. consumer spending share from 1992 to 2025. Back in the day, the middle bracket controlled 37% of spending. Now, they're down to just 28%. Meanwhile, the top 10% of earners have completely swooped in and filled that vacuum, jumping from 35% all the way up to 48%. Think about that. Just 10% of the entire country now controls nearly half of all consumer spending. They are effectively hollowing out the purchasing power of the middle class entirely.
And this divide is also incredibly stark when you look at it across generations. Baby boomers are currently holding on to a staggering $83.3 trillion in assets. By contrast, you take all the millennials and Gen Z combined, and they hold just $17.1 trillion. To even survive this kind of wealth gap, younger generations are increasingly being forced to rely on hidden debt traps. I'm talking about the explosive popularity of things like buy now, pay later schemes, which is essentially phantom debt that often doesn't even show up in official federal data.
Okay, finally, let's talk about what we can actually do. Section 6, the survival playbook, navigating the shockwave. The system is fundamentally lopsided right now. So what do you actually do with all this information? Well, the goal here is resilience. You want to try keeping your assets insulated from the shadowy banking system we just talked about. But I have to be clear, there is absolutely no such thing as zero risk. You could look at gold, which is a classic inflation hedge. But remember, it yields zero interest when rates rise. Commodities like grain or energy are another option, but those carry incredibly high geopolitical volatility. The traditional 60-40 stock and bond portfolio is definitely safer, but over time it may heavily underperform an all-equity portfolio. And if you're looking at real estate through things like REITs, you are still totally exposed to property taxes and sudden demand shifts. The absolute key here is understanding these specific trade-offs before making a move.
Which leaves us with this final, honestly pretty provocative thought. As this K-shaped divide becomes more and more permanent, you really have to stop and ask yourself, are you actively moving toward asset ownership, or are you already bleeding out in the service world without even realizing it? The math clearly shows that the window to transition from one side of that K to the other is closing fast. Thank you so much for joining me on this explainer today, and I really encourage you to go take a hard look at your own financial reality through the lens of all the data we've just explored. See you next time.